We actually directly compete with Fannie and Freddie. We provide pretty much the same function, right? We provide an underwriting technology and approve eligible, and then we provide a capital market. So we are absolutely more of a competitor. And explicitly, when someone's deciding to sell their loan to Figure or use the Figure technology, they are not using Fannie Mae. That said, a lot of the fintechs that work with us don't really even know about Fannie Mae. We just have made it so easy that they're in the mortgage business in a way that they wouldn't be if there was no Figure.
This is the FinTech One-on-One podcast, the show for fintech enthusiasts looking to better understand the leaders shaping fintech and banking today. My name is Peter Renton, and since 2013, I've been conducting in-depth interviews with fintech founders and banking executives. Today on the show, I'm delighted to welcome Michael Tannenbaum, the CEO of Figure. Now, most people know who Figure is, but they are a blockchain-based capital markets company that went public in September of last year. Before Figure, Michael worked at some big fintech names. First at SoFi, where he rose to be the chief revenue officer, working alongside founder and then CEO Mike Cagney, as well as Brex, where he was employee number one and eventually became COO there. In our conversation, we talk about how Michael established his own leadership direction after taking over from Cagney, how Figure's origination and capital markets platform works, and why it competes directly with Fannie and Freddie, the mechanics of cutting mortgage costs from $12,000 down to $1,000, why tokenizing real-world assets is more nuanced than the hype suggests, Figure's SEC-registered yield-bearing stablecoin YLDS, and the three growth areas Michael is focused on over the next 3 years. Now let's get on with the show. Welcome to the podcast, Michael.
Thanks for having me.
My pleasure. I'm good to finally get you on. I feel like I should have had you on years ago. You had such an interesting career. I know we've known each other for quite some time. You took over CEO from Mike Cagney, who I've had on the show 3 times in the past. He's obviously one of the big names in fintech. So let's get started by give the listeners a little bit of your background. I know you were at SoFi with Mike. You were very early at Brex. Tell us a little bit what you've done in your career.
Thanks for having me. As you mentioned, I've been in the fintech space for a bit now. I started actually in investment banking doing regional bank M&A during the financial crisis or a little bit after there. So kind of part of that cleanup. I worked at a private equity company in San Francisco, and then I found my way to SoFi pretty quickly. And I joined there around the 75th employee. So it was relatively small. You could name everybody in the company. And I worked my way up there. I didn't start reporting to Mike. I started reporting actually significantly far from him, even though it was a small company. And we started working together when I became the head of the mortgage business. And I was kind of rising the ranks at SoFi, ultimately became the chief revenue officer. As you noted, I left to join Brex as the first employee. It wasn't actually called Brex at the time. It was called Beyond, which I had an issue with because you can't really spell Beyond from hearing it. So it's like, how do you spell Beyond? In that case, it was Veyond, but it could be other ways. And so, especially if you speak French, Beyond is meat in French. So anyway, so then I worked there for about 7 years as a variety of titles, but ultimately the COO. And then we just sold, I was on the board when we sold the company to Capital One. And as you noted, I took over as CEO in early 2024 of Figure, and we went public in late 2025, September. And it's been a really exciting time, and it's been really fun to be back with Mike. As you noted, he absolutely is one of the big names and personalities in fintech and now in blockchain as well.
Let's start there. And Mike is obviously brilliant. Anyone who's spoken to him for more than 5 minutes will know that. And he had, I'm sure, a very big presence within Figure. You take over as CEO. How did you think about establishing yourself and your own direction at Figure after taking over from such a unique person like Mike Cagney?
It's a good question. And I started with this first principle. Both Mike and I, we share some things and we obviously don't share other things. But one of the things we share is this kind of first principled approach to thinking. And what I told the company when I joined is this company is successful, right? So there's not a lot that we need to change because company's working. And so it wasn't a turnaround or any kind of scenario like that. And I think two things helped me do so. One was I really understood the problem space coming out of SoFi. When we were at SoFi, we talked together about the opportunity to use blockchain to lower transaction costs and third-party diligence review. We talked about the home equity opportunity and that 80% of the personal loan customers were homeowners. So I had that kind of background and the confidence to understand Figure. I had invested in Figure. And I also focused on something that I had learned well at Brex, which is this concept of big rocks. And I think that was an opportunity for Figure because Figure was doing so many things. To your point, Mike is really innovative and he likes to do a lot of things and he likes to start a bunch of different things and see what works. And he'll be the first to say, not everything's going to work, and he'll do a lot of 0 to 1, and I'm more of a 1 to 100 kind of person. But the mandate of the job was that we wanted to go public, right? That was very much a part of my role, is being the person to bring the company towards IPO. And so I focused us on big rocks, right? This idea that everything we do needs to build up to 1 to 5 maximum different goals. And that was the focus for me early on, is kind of taking all the things we were doing and really focusing us on this future of the capital markets on blockchain. I mean, Figure was always focused on that, but I don't know that we were saying that out loud and that we were laddering up the way that we worked and the projects we did so clearly to that North Star. And so that was a big part of my early time.
So then, Figure started off in the HELOC space. Maybe we should step back and tell me, let's talk about how you describe Figure today.
So we are building the future of capital markets on blockchain. As you noted, we started in the home equity space. And in particular, we were one of the first people to do consumer loans on blockchain rails. And over time, we built a really broad ecosystem of partners that use our technology to originate mortgage and other assets into a capital markets that comes completely embedded with that origination technology. So there's nothing really else that works like that besides sort of Fannie Mae. And so we have about 300 partners that use this technology to lower costs of origination, increase speed, and get guaranteed liquidity for the loans they want to make. And that today does about 1.3 billion a month. We've done 24 billion of this. We're growing 100% year over year at 50% margin. So we're roughly rule of 150 in a world that focuses on rule of 40. And then we've taken that lead and that capital market that we've built in the mortgage space and extended it more broadly into DeFi and opened it up to other asset classes that want to borrow and lend against assets. And essentially, for like a fintech oriented audience, we've built a almost universal warehouse line that we call democratized prime that is much easier to borrow and lend against than the arduous process of getting a warehouse line with lots of third-party diligence and legal fees. So we're kind of building this big capital market that is on blockchain rails, and that's really our goal.
So, full disclosure, I actually am a Figure customer. I took out a Figure HELOC a couple of years ago when rates were really low. And I remember at the time it was a seamless experience. It was easier than taking out an unsecured consumer loan, it felt like to me. As far as the lift from the borrower was really light. Now I am a member of a credit union because I imagine that the loan was sold to them. What I want to do is just to understand the system that you've built. Can you take us through the process? And I know you're doing more than HELOCs, but let's just start with HELOCs. That's a really popular product. It's easy to understand. Take us through the process of origination and the capital market side, and how does it work at Figure?
Happy to. And before I do, I'd like to comment that I tend to I use the term mortgage rather than HELOC because about 22% of what we do up from, call it 12% year over year, is first lien, meaning not a loan on top of another one, which a lot of times people associate with HELOCs or home equity. And these are true replacements for mortgage where we're competing directly with Fannie Mae and Freddie Mac. So because of that, I find that a term like HELOC doesn't totally do justice to what we do. But yeah, so most of what we do is B2B, as I mentioned. So it's the partner network, 300 different banks, credit unions, mortgage companies, fintechs that use our technology to originate what we're going to talk about mortgages to their customer base using our technology in their name, using their balance sheet, but then selling into our capital market. So that's the average loan at Figure today. Figure Connect is that marketplace where people use their own balance sheet. And that's about 60% of what we do, up from zero as of June 2024 when we launched it. So it's been a really fast growing marketplace, which we could talk more about. But to answer your question, what will happen, to use let's say a bank example, the bank is offering that product to their customers in their name. So if it's Peter Renton Bank, it's, the Peter Renton Home Equity Express product potentially. And what's happening is the customer, the bank, is using our technology, pinging our system to determine the eligibility. If the customer is eligible, then the loan will proceed, and everything is happening in an automated fashion. There's no underwriters, there's no people in the process. We're connecting with the bank account of the customer, underwriting the income. We are using an automated appraisal approach. So we use an automated valuation model for the home value. We aren't using a title insurance process, but instead are automatically determining the amount of equity and what's owed on the property based on county level information and other data vendors. So we skip a lot of the back and forth that normally happens in a mortgage process. And as a result, we're able to bring the costs from industry average of about 12,000 down to 1,000, and from 45 days down to 5. And as that loan is then manufactured, the outputs of the loan are actually put immutably on a blockchain. And then what that means is there's significantly less third-party diligence that's done on the loan, about 80% less, due to our use of blockchain and the immutability of those data attributes upfront. And then that loan will be sold into the capital markets. We'll take a fee at the time it's sold, and the loan will either go to a whole loan buyer, to a securitization, to an insurance company, and a Figure will be the servicer. So we'll do the statementing and the payment collection process throughout.
Although couldn't that Peter Renton Bank you talked about, couldn't they keep it on their balance sheet? Does that happen much?
It can happen, and it would happen with a bank more likely than a non-bank for sure, for obvious reasons. The thing is that mortgages are longer term assets. So a lot of people, even banks, enjoy the flexibility of being able to take that and put it in securitized form, where they might get a more favorable capital treatment, and they still may choose to buy those bonds, as an example. But yes, and one of the advantages, and I think this speaks to how different what Figure is doing is the fact that a bank could hold it on their balance sheet and then 2 years later decide to securitize it. And there's so much liquidity in what we do because we've standardized this approach across these 300 people, these partners, right? These 300 partners, and that brings liquidity, and that standardization brings liquidity. And what that means is they have the optionality of changing their mind, because interest rates change, balance sheet needs change, market changes. And so the flexibility of deciding, I want to make and hold this loan today, but then in the future, I may want to securitize, is something that, again, only the Fannie Mae market really has. Otherwise, if you think about all fintech, I mean, there's just no liquidity for any of these products. I go back to Brex, where I worked for 7 years and I led the capital markets there, did the securitizations. We had a competitor, well-known competitor, Ramp, who was doing the same thing from a credit perspective and a capital markets perspective, but spending all this time building out their own capital markets chassis, their own underwriting, just as Brex was doing the same, and other providers in the space. Whereas Figure is saying, well, all this should be unified because these companies aren't really competing on capital markets and risk. They're competing around product experience, marketing. And so it's just the way that the market has evolved. But the mortgage market, because it had government intervention, actually evolved differently. And we're taking some of that insight, modernizing it by using blockchain technology and bringing that to the broader fintech ecosystem.
Some of your clients, are they, I mean, I imagine some of them are selling these on to Fannie and Freddie, right? Or are they all just going into your marketplace?
We actually directly compete with Fannie and Freddie. So
Okay.
you wouldn't, we provide pretty much the same function, right? We provide an underwriting technology and approve eligible, and then we provide a capital market. And explicitly, when someone's deciding to sell their loan to Figure or use the Figure technology, they are not using Fannie Mae. That said,
Gotcha.
a lot of the fintechs that work with us don't really even know about Fannie Mae. We just have made it so easy that they're in the mortgage business in a way that they wouldn't be if there was no Figure. So I think a good example of that would be Pin Insurance, right? They're a homeowners insurance company. They do have relationships with homeowners. They wouldn't consider themselves a mortgage company or probably be in the mortgage business if it weren't for Figure. I think another example of that is House, which is a housing and design platform that originates loans at the point of sale. And they wouldn't do that. They wouldn't really be a mortgage company. They probably, I mean, they may have heard of Fannie Mae, but they don't think about choosing us versus Fannie Mae. Whereas we have customers that are independent mortgage banks that are very explicitly making the choice at the marginal loan, whether or not to send it to us or Fannie Mae.
That's interesting. So then I think I can't remember the numbers that you said. Was it 7,000 down to 1,000? The cost?
12,000 down to 1,000. That's
12,000 down to 1,000. Now, how much of that is the technology that you've built that's blockchain based, and how much is just your sort of more efficient front end?
Well, it's definitely not just a more efficient front end, because you can't change the way loan origination is done without changing the capital market. And the main thing that we do is we built a front end that feeds a capital market. And there's really nothing else that works like that. Meaning that when a loan is processed through our software, it is eligible for our capital market. They're the same thing. And nothing else works that way. And so everybody else is trying to use an origination system and then on the back end figure out where to sell the loan. And that figuring out process creates all this back and forth between the lender, the borrower, and the ultimate buyer. And we eliminated that, and we eliminated the people-based approach and standardized it. And because the capital market itself is on blockchain rails, using blockchain principles, which get at that standardization and that immutability, you can't really separate them. It's kind of like saying, blockchain is sort of like cloud, right? It's a way of doing things. And so when you go to Salesforce and say like, well, how much of it is the features versus how much of the fact of early Salesforce, right? How much of the fact is that it's in the cloud? Well, the fact that the features can be updated automatically is related to the fact that the software is in the cloud versus downloading it, but it's not the cloud, it's the feature, it's the whole thing. So that's kind of the way I would think about it. It's the technology that's enabling a way of doing business and capital markets.
Right. So I do remember it was actually at one of our old lended events. I think it was 2018 when Mike described this, what you've just laid out. He put it out there. And of course, everyone thought this is crazy. Like no big investor is going to want loans that are sitting on a blockchain. That's too heavy a lift. It's too far removed from the way things have always been done. But it sounds like that's no longer an issue. Like I imagine you've got the companies that are in your capital markets. I imagine there are lots of the traditional names we'd all know, right? They've overcome that objection.
That's right. We were the first to securitize blockchain assets, the first to get a rated securitization of blockchain assets, the first to get a AAA rated securitization of blockchain assets. We have over 20 different whole loan buyers, 20 different securitization buyers. We have a joint venture with Sixth Street, which is traditional asset manager, which acts as a guarantor, sort of like a lender of last resort, if you will, or kind of a permanent buyer in the ecosystem. And I think actually the most recent past, call it 6 or 9 months, has been a watershed moment for blockchain in the capital markets with some of the fraud we've seen from Tricolor, First Brands, and then MFS in England. because this idea that you can double pledge loans has become part of the zeitgeist and part of the concern in the industry.
Which would be impossible on your
Exactly.
system.
And so maybe in 2018, people were thinking this is so crazy. Now people might be saying it's crazy not to do this, because the idea that you're just sent a spreadsheet and a wire and you hope that somebody hasn't also sent that spreadsheet of loans to someone else seems insane.
Right, it does. So let's move on to some other topics here. Let's talk about tokenization, because everyone's talking about all real world assets will be tokenized. It's inevitable. You're obviously showing that you've got your corner that you have tokenized and put on blockchain, and it's obviously going really well. But when you hear people say it's inevitable, all real world assets will be tokenized, what do you think?
I generally agree, but I think that there's a path that tokenization will go and will be where it adds the most value. And that tokenization doesn't necessarily mean liquidity. And so I'll break that down. If you look at what Figure's done, we have tokenized generally consumer loans that have more in common than not and should have liquidity but don't. Meaning, from the perspective of a debt instrument, consumer loan interest rates are relatively similar in the same asset class, say mortgage, and you have properties that are relatively liquid for the most part, and you have lots of home equity. There's 35 trillion. And so a loan to someone in, let's say, suburban Boston in some single family home there with a roughly similar credit and roughly, similar income is very similar to somebody in suburban Dallas with similar characteristics, right? And you should be able to buy and sell loans like that in pools and be able to trade them and move them around, because from the perspective of an institutional investor, there's a lot of liquidity in that. And it doesn't really matter who originated the loan, as we were kind of talking about with the Brexit ramp example. And so blockchain can be used to standardize and bring liquidity into that space. And there are lots of examples where this will happen. But there is also, I've heard people from my investment banking class, kind of going back to where we opened, that's come to me and said, oh, I've got a couple of warehouses in Costa Rica that I'd like to put on the blockchain. And it's like, okay, but that doesn't necessarily mean that there's liquidity for those warehouses, right? They're relatively unique and they're big and they're tied to real estate in a way that's much less liquid and much more bespoke. And just because you put those on a blockchain doesn't mean that there's all of a sudden liquidity or interest, right? There's less capital in tokenized liabilities, so stablecoin, than there is outside of stablecoin, obviously, right? Most liabilities are not stablecoin. Most people have fiat. And therefore, you don't just create a market by tokenizing something. You need to also think about the principles of liquidity and standardization, and also lien perfection, right? Which is a big part of what we were talking about with the double pledging. Figure uses our digital asset registry technology to perfect the lien and ensure a digital padlock on that asset and ensure that nobody else can own it. And those are the types of things that work really well for blockchain, whereas all assets, for example, if you think about certain food, right? Like if you're trying to tokenize potatoes or something like that, that would be a challenge, even though like there are commodity markets that might work for that. But because if they're not digital assets, it's harder to do that lien perfection or verify them or track them, at least with blockchain technology, right? It could be other technology that works for that, maybe AI, right? Maybe satellite imagery. There's other things you could look at, but in terms of blockchain, it works best with digital assets, which is why equities can work, which is why, loans can work.
Well, since you mentioned stablecoin, let's talk about your YLDS, your yields stablecoin.
Yeah, we pronounce it yields, but YLDS also works.
Okay.
Peter.
So it's an SEC registered yield bearing stablecoin. So who's it for, and how do you explain it to sort of your capital market? Maybe there's community banks or credit unions that are curious about this. Well, tell us all about that.
I'd compare it most similar to a tokenized money market fund. It's not a Genius Act stablecoin. As you noted, it's SEC registered. However, it only invests in Genius Act eligible collateral, so treasuries. And what's unique about it is that it functions like a stablecoin. It's peer-to-peer transferable, but it also pays yield because it's a security. And we see its value in terms of corporate treasury. So it's a common replacement for on-chain treasury. If you're already in the blockchain space, or you're already working with stablecoin and you're looking to earn yield because you have balances outstanding, this is a perfect product. And it also acts as the oil of our capital market. So going back to the example that we talked about where you're buying and selling loans or pledging loans, we can actually make that atomic, meaning that you can convey the ownership of loans at the exact same time money is received in stablecoin, sort of like a revolving door clicking in and at the same time. And so that's a really powerful use case for our stablecoin. And in general, increasing amounts of our loans are serviced and transacted with stablecoin, and in particular, our yield stablecoin.
So I want to talk about your IPO. You raised $787 million September of last year. Tell us a little bit about that moment, why you decided to pull the trigger then, and what being public has changed about how you and Figure operates.
As I mentioned earlier in the conversation, it was part of the mandate to come to Figure. And I had been initially more hesitant and didn't feel ready. I don't know if you ever fully feel ready. It's not, it's not something I haven't like done 7 IPOs in my day, so I can't totally comment on that. But for me, I was, of course, a little nervous, and, it's hyped up so much. And so I was thinking, we'll probably hang out, grow, stay private for a bit. But the regulatory environment started to change when Trump was elected, and the SEC clearly was going to be more favorable to blockchain. And at the same time, you also saw a window start to heat up in basically a year ago from today, essentially. Early mid-May, I think eToro went public, which kicked off the sense that not only for crypto, but just for kind of high growth tech, there was going to be more activity. People use this phrase, animal spirits in the market, and you need to have kind of that conducive environment. And at that point, I had gotten some advice from someone I had worked with at JP Morgan a while ago that said, Figure, and you've mentioned this kind of softly, Peter, which is like, Figure's not the easiest company to understand. We're not Procter and Gamble, right? We don't sell toothpaste. Right. So there's markets where people are leaning into stories like Figure, and then there's markets that are cooler where people candidly aren't. And when you have one of those markets and you have the SEC, it's incumbent on you as a leader, especially if that's the mandate, is like, you got to hit that window. And timing is everything in this world and in capital markets in particular. And we knew that this was going to be the moment. Mike was definitely in alignment there. Obviously, he's the largest shareholder, so it's important to get his alignment. But I kind of was like, look, this is the time to go. And people say you need a lot more time than we gave ourselves. And I think we just were very focused on hitting the market right after Labor Day, which ended up being a perfect window. But the reason I mentioned that is because if we had waited 3 weeks, there was a government shutdown and nobody could get to the SEC. And that lasted through November. And that just shows you the point, which is you need to be ready and hit that market when it's ready, if this is something you want to do, because these windows open and shut. We've seen the Iraq war. We saw the tariff tantrum. Like, these things really change, and you have to be ready to hit the window when they're open.
It's a good point. So not only that, because you see interest rates change quite dramatically, that has a sizable impact on the housing market. We've seen that when rates went up, over 7%. Then you've got crypto that it comes and goes. So how do you sort of navigate? How do you build a company that is sort of agnostic to all those changes?
We've done a good job of building a company that survives both rate environments that are higher and lower, and also a company that has survived regulatory environments that have been more and less favorable to blockchain. And as an example, the yields stablecoin security that you mentioned was developed under the Biden administration, and many things we've done, and we thrived during a time where blockchain was not only not a focus for the government, but in fact a hindrance. But we were able to survive and thrive. And from a rate environment perspective, generally lower rate environments are better for the mortgage market and for all of the kind of consumer credit markets. But Figure has also benefited from the fact that when rates are higher, people look to get mortgages on top of an existing lower rate mortgage. And that's a portion of the business that we do. So we've been successful both when rates were going down as well as when rates are going up. And I think it's very important that we have a business that can survive through a variety of these markets because, as you noted, things are changing rapidly all the time.
Okay, so last question. You've got a lot on your plate right now, it feels like, but I'd love to kind of get a sense of where you want to expand this. Obviously, the mortgage market is massive, and Fannie and Freddie are massive, and so you've got some runway there. But what do you think about over, say, the next 3 years? What's the growth areas for Figure?
3 primary areas. The first is, the consumer loan marketplace that we're executing into. We've done about 24 billion. We do about 1.3 billion a month. That's a 2 trillion annual origination market. So we're barely scratching the surface. Again, also looking at it from a home equity perspective, there's 35 trillion of home equity, and we're doing about 1.3 billion a month, right? So this is a massive TAM that we're executing into. And because we lower the cost so much, we actually see a huge amount of that market as addressable. Then I look at democratized prime, which I mentioned is our, call it either commercial paper market or universal warehouse line on blockchain and DeFi rails. Ultimately, I think all of the kind of financial assets that you can borrow or lend against will migrate to something like that, to that future of tokenization we talked about. And that's actually a larger opportunity because all third-party origination that we can ultimately use a combination of AI and blockchain technology to adapt these assets to our capital market, we can bring on and make much more liquidity, at least in the short-term borrowing and lending. And so that opportunity extends to other fintechs that bring their assets onto our platform, like Agora, which is an auto lender that we announced a partnership with 2 months ago. And then the third area is the broader opportunity outside of the debt asset classes. So things like equity and commodities. And Figure has some unique perspectives on those areas. For example, we launched our all blockchain equity on our platform, Open On-Chain Public Equity Network, earlier in February. And that's an opportunity to kind of gets at the same principle of democratized prime, where there's a lot of kind of middlemen in equities and in commodities that extract rents, but don't necessarily add anything. And at the same time, obfuscate ownership and make it more difficult for bilateral trading. And we see a world, I kind of like to compare what the internet did to content creation as what we're doing to asset ownership, right? We are turning over the ownership and the economics to the people that actually own and originate those assets, rather than people in the middle using our technology. And so I think that's the multi-year opportunity for us, Peter.
Okay, well, we'll have to leave it there, Michael. It's really fascinating to chat with you today, and I loved the color you're able to provide to Figure. As you say, it's not easy to understand for a lot of people just looking at it casually, and I think you've provided a great deep dive for everybody who's interested. So best of luck, and thanks for coming on the show.
Thank you for having me.
One number from this conversation really stood out to me: 150. Figure is running at what Michael called the rule of 150, growing 100% year over year at 50% margins in an era where most investors celebrate a rule of 40. That kind of performance in a company that also just went public in a market as rate sensitive and entrenched as mortgages is not what you would expect. It tells you something real about what happens when you eliminate the friction between origination and capital markets, rather than just making one side of it marginally more efficient. Anyway, that's it for today's show. If you enjoy these episodes, please go ahead and subscribe, tell a friend, or leave a review. And thanks so much for listening.